we've decisively broken the uptrend in the U.S. stock market that began on the lows back in 2009. And we've had a bounce back in the last few days. You know, we had the biggest drop point-wise ever in several days and the biggest rally. But that rally didn't change the technical damage that was done in the sell-off. So I think we've broken that bull, and this market is in correction. It's going to continue to correct. It's probably going to go into a bear market unless the Fed can rescue it, unless the Fed throws it the life preserver that it needs, which is no rate hikes in QE, instead of dangling an anchor in front of it in the form of suggesting that maybe rates are going to go higher. And even though the Dow itself is in correction territory, there's about a third of the S&P 500 that's already in a bear market. These stocks have already dropped by 20% or more, but this is being masked by the averages. And the averages, of course, are going to be influenced by some of these high-profile names that in many cases are extremely overvalued and vulnerable to big declines if the Fed were to actually follow through with its threats to raise interest rates.
Okay, on the screen right now, you can see the chart that Peter Schiff was referring to. You see basically on August 21, right here, this candle right here, the market breaks below the channel it has been in for quite some time. This channel goes back to, goes back even further. There we go. It goes back to August of 2011. So basically 4 years, in the past 4 years, August 2011, that channel was finally broken on August 21 of 2015. And since then, you know, the market has rallied a bit, right? We zoom in. We see the market, you know, fell sharply below that for 2 days. And the market has been rallying since August 24. We have seen, you know, a steady march upwards. However, we've still broken the trend line. The market is still below this trend line. So that's what Schiff is talking about when he's saying that technical damage has been done. And, you know, you're seeing a bit of a rally, but it's not enough to undo the technical damage that's been done. In other words, we are still below this trend line. We've still broken the trend line. And so it's actually quite reasonable for the market to rally back up to test this trend line and then for it to resume. In fact, a lot of short traders will probably do just that. If the market can reach the bottom of this trend line here or this horizontal support level at 2038, resistance level, excuse me, that's an opportunity for traders to enter and short. So that's the basic idea. You know, the break of this trend line is the biggest sign that the bull market, the uptrend in the S&P 500 is over. But in addition to that, we do have this horizontal range that preceded the breakdown, which could be interpreted as a distribution pattern, a pattern of sellers, you know, slowly getting out of their position, big money slowly getting out of their position, and that paves the way for a decline. That's about it. Just wanted to sort of explain what Peter Schiff was talking about when he said that the trend had been broken and technical damage had been done. Any questions you have, anything you want to add, join us at informedtrades.com. Best of luck in your trading and investing, and we'll see you next time. Take care.